be able to go in depth with pairs, but I can tell you about commodities that are worth your while, which, it's just another avenue for you to use while also being informed of what's going on in the marketplace. First of all, for anyone who's unaware, if you've been following the most recent episodes of the podcast, they have been not only pretty spot on, especially if you remember with oil, and not oil spot price right now, but what it was, like maybe like 2 weeks ago, and getting to, progressing back to highs again. I wanted to just point people's attention to the fact that there's about like 6 new Trade Talk episodes. Again, these episodes focus on a lot about macro concepts that you can apply to what you're currently doing in your trading. One of the biggest ones that just recently came out, and this goes for anyone who is trading US 30, trading anything that has to do with bonds out there, is that they're going to start to introduce what is called the Uniform Mortgage-Backed Securities futures contract. This is going to be huge. What it's really telling you is that there's a dislocation in the pricing of U.S. bonds, meaning the long-dated bonds are pricing something that is not matching up to what the Fed is trying to do with raising rates. So when they raise rates, you get exponential jumps with the long-dated bonds. That has been happening, but the dislocation comes in the 20-year maturity and the 30-year maturity. So without this being complicated for anyone, what it's in essence saying in its simple form is if you choose to be long-dated bonds, you will probably end up very profitable in the next like 6 to 8 months. You'll end up being profitable in those bonds simply because they're trying to correct the yield curve. And when you're correcting that yield curve, you want longer dated maturities to be worth more than shorter dated maturities. It's pretty much that simple. I know that might sound, a little confusing, but it makes sense. Long dated maturities of U.S. treasuries and bonds are going to be worth your while for a long hold, if you will. But I also understand that some people are in the particular position to scalp and find your progression in whatever the charts are showing. If that's the case, another place that you're going to make money is in oil. Though most people are feeling like, you short oil, obviously, the shorts are working right now. You have to look at it from the total aspect of what is happening. You're trying to get demand destruction, but you have this very much a situation of where people are absorbing inflation. For those people who are around or in the US, people have not slowed down traveling, which means they're absorbing the pricing. If they're absorbing that pricing, especially if you just saw the most recent statistic from Department of Transportation, over 44 million people are planning on traveling by car this holiday season. That means they're going to consume that inflation at the rate that it's going. So don't be surprised if you get a higher CPI print coming in on the next reporting of CPI. People are absorbing these prices. What does that mean for crude oil? It's not going to continue to fall. You're going to have consumption, and you should expect that. You always want to try to not predict, but you always want to take into account where the market is going and headed, and anticipate for that, just as well as you're paying attention to where your charts, are headed, and what will be based off of the training you've received from Jessica. But still pay attention to what is going on macroeconomically. It allows you to get in at an even cheaper price as this thing ends up playing out, because it will play out. Airlines, people are traveling, they're absorbing these prices. Social media shows you that they're complaining about the pricing. However, their discretionary dollar is saying otherwise. you always go by what the data is saying with what they're doing with their dollar. And something like energy is actually non-discretionary, but on, when you do vacations, it's discretionary. Nonetheless, it is to say it falls under both categories, and people are choosing to not only pay the higher prices for the non-discretionary, where it's like in their home and they have to have the energy and the gas, but when they choose to travel, they're choosing to pay even extra for the discretionary, and it's going to continue to lift the price. I feel oil should be somewhere around the 140 to 160 mark. People are often not aware historically what happened in 2009 going into 2010. You can look this up whenever you get a chance. But what happened is oil prices were high. Obviously, in a recession, people were complaining. And even as they were high, they still topped out at 140. So I remember in the summer months they were high, and it kind of took a dip coming out of the summer months. Then in the winter months, caught a very, very strong demand going into March, April, May to hit its all-time highs of 140. So I highly believe that you will get a 140 to 160 print. We're in a different type of environment where you can easily obtain that. Another one where I was looking at things, but I don't think that you trade this market within your trading platforms. But if anyone is familiar with this market, soft commodities. I know hard commodities are often traded in like FOREX, but I don't know if like lean hogs, cattle, pork bellies are traded, or even grains. They're very, 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 very much to your benefit to start looking at in trading, especially as we are in this inflationary period, because your soft commodities are seasonal. The majority of them are seasonal. And just in case anyone's not aware, chicken is not one of the tradable soft commodities, but pork and cow are. And in this particular case, in the summer months, this is when they start their raising of the calves and the baby animals for slaughter. But what is happening currently is that if you have that issue, well, not if you, but you have the issue in Ukraine, it's costing more to not only have wheat, harvest wheat, move wheat, because a truck moves these things and it's moved with diesel fuel. Diesel fuel on a national average is about $6, with a projection to be $9 by the end of the winter. That is going to be passed on to your cost of your food. I know some people are aware that, like, hey, it costs me more to eat my fast food, buy food at the grocery store. Obviously, those things are passing along, but you haven't even gotten to this new cycle of consumable animals for slaughter. And as you get into this coming into the fall, you will see prices spike. One of the key indicators of this is that, and this is also another indicator of why you know that oil is going to have a higher price, you cannot lock in the price of diesel. Meaning, if you want to buy a future dated contract as a person who wants to take delivery, not to speculate, but taking delivery of a future price of oil, you cannot currently. It's projected to be at $9 to $10 by the end of the winter. So pretty, if you've done your research, pretty clear to see that there's going to be some aggressive price appreciation on the speculation of soft commodities, and especially, soft commodities, but then also especially for hard commodity like oil. So hopefully people can understand what I'm saying there. And I know it's not maybe an immediate market, but it might be a market that you might want to take the time to, maybe understand or start to pay a little more attention to, because as long as we have this kind of inflation with strong CPI prints, people are going to have to absorb food costs, and people will absorb food costs till they cannot take it anymore, or the government steps in and, gives them some reprieve. If you see where the government was trying to step in for reprieve, it was where they were trying to give a 90-day gas tax cut. Obviously, that's not going to be done. Anyone who's believing that can be done hasn't paid attention to what our political system has been. You only got a very quick gun legislation bill because people are being killed. But for something like tax on gas, they will fight that tooth and nail, and it won't get done before the end of the winter. And once the winter kicks in, it's not going to matter. And we will be there faster than people even realize. Congress goes on vacation in August. So you only have so many more weeks till they're not even there. And then after August, you have it in October where the fiscal year ends. So they're never not going to do anything there. If you remember from these past 2 years, no one does any work in October. So you really don't have that much time to get this done, and it won't be done. So that's that aspect. This one veers a little bit away from my next subject. Veers a little bit away from I don't want to say like forex markets, but I think it's a market that people should pay attention to, and it is consumer brands coming into the holiday season. Again, if people are facing inflation and a lot of their discretionary dollars having to be put into non-discretionary places, well, they're probably going to consume less, whether not even to say luxury items, just less brand items, right? If they're going to not consume those things, or you're going to have a weak holiday season, which you're going to have weak retailers, and you're going to have probably some bankruptcies coming up. It's not to say that, the world's going to hell. It's just to say this is how the economy starts to work, right? The same way you've been taught to make money when you see certain indicators. Well, there's macro indicators that are showing what's going on. And what those macro indicators are specifically, it's becoming harder to finance. The same way someone would say, whoa, it's harder for me to, like, it's not even harder. Like, I could still get this house if I wanted, but it's going to cost me more. Well, it costs corporations more to function when interest rates are getting higher because they have to finance at a higher rate. That's what's going on. So when you ever used to wonder, like, oh man, it's some bullshit. Sorry to curse, but I know people were saying this. You gave corporations money and they're buying back their stock. They're buying it back because they need to either get rid of some debt, be able to raise equity at a different time, or refinance, because they knew this time would come where they would raise interest rates and it'd be hard for me to finance. So that's what's happening. So those of you who may trade some stocks, who may do some certain things, you really should pay attention to that. There's going to be a lot of money to be made there. Sorry, give me just a quick break here to get a sip of water before I go to the next parts, and then we will wrap it up. So another place I was focused on, and I can't tell it to you in the most perfect setting. You've started to, for those who were on a call, maybe, it's probably like more than a month ago, probably 2 months ago when I was on. I was talking about New Zealand debt, and I don't know if people trade New Zealand pairs, but you should start paying attention to the strength of the dollar against New Zealand currency, but not only just because, it's just a great trade. It's because you're having an issue in New Zealand with adjustable rate mortgages, where just like in the US, where the housing market is cooling down, the problem is interest rates are going up. They're trying to service these debts, and it's harder for them to service the debts because the new adjustable rate to their mortgage is higher than it was before. And a lot of New Zealanders, they don't have a lot of exposure to the dollar, but their banks have a lot of exposure to the dollar. So depending on how they denominated, like particular banks, depending on how they denominated their loans, there's an exposure there, which most people cannot immediately see, nor I think they could understand it, but they can't immediately see it. There's an opportunity there. So maybe at some point, Jessica would, well, I don't even know if Jessica has to do it, but I can have that conversation after I like really make it in a very simplistic way where I could present it to everyone and show you, the fine points of where the buy and the sell is, if, she would have me, or you guys would want to know that. Again, before I close this out, I want people to understand, though I'm talking about sometimes some subject matter that everyone may not immediately get, the purpose of getting it is to really be able to give you convictions when you want to trade things, and be able to hold a little longer if it all makes sense to you. I'm not trying to veer you away from what Jessica has taught you. I'm more so just trying to give you some market commentary to understand what the other side is kind of looking at, because they do look at some of the things that you're doing. They just kind of use different indicators to notify them as to why they should do it and why they should put in this much size. So I thank you guys for having me. I will take a few questions, and then, till next time.
I got a question.
I guess we could just ask a question. Yeah, go ahead.
If inflation is hot all around all currencies and interest rates aside on all currencies, how would that affect the Forex market?
It depends what denomination most of the debts in that country were done in. So remember, like China was a good example. Even though I know people weren't trading Chinese pairs, there's a lot of Chinese debt that's actually dollar denominated, which means it costs them more to service it when the US dollar is getting stronger. And what people weren't expecting from a global aspect is that the dollar would get stronger. They're expecting, to be strong because you're increasing interest rates, but like it's really performed pretty well against a number of pairs, not all, but a number of pairs. So inflation can run hot, but it depends how that country has the majority of their debt denominated. And I don't know if enough people pay attention to something like that, but when you start listening to the news of how a country may have issues paying their debt, the next thing they talk about is how it's denominated.
Thank you.
You're welcome.
This is Aaron out of Oakland. I have a question.
Yes, sir.
Yes, sir. Thank you for the information. Just to kind of dial in a little bit more about what you were saying around the New Zealand compared to the US dollar. Is it your expectation that because of their housing situation and their kind of leverage situation with the dollar, the exposure that you referenced that the banks had, do you expect that this will like bring their currency down?
Yeah.
That's what I thought you meant.
Yeah, and like I said, if Jessica will have me, I'll do like a whole presentation just on that one. I don't know if so many people trade that pair, but I'm telling you, it's going to be a thing because New Zealand also ties with the Aussie dollar, and they're using all the same system in terms of like where you can't get a fixed in those markets, you get an adjustable. So it's going to matter a lot. Yeah.
Wow. Thank you so much for that information. It's super, super helpful.
You're welcome, sir. Oh, sorry. There was something in the chat. I didn't even realize there was a chat. My bad. I don't know enough about Zoom. What are your thoughts on Russia, China, India, and others trying to create a new fiat currency? Well, that's okay. So I love this question because I was I was watching this thing where Jerome Powell, like it was just the last Fed meeting, and Powell is talking about how they were doing, digital payment systems and this. And I was seeing on social media where people were like, it's the new world order. See, this is why you get this, and that. And I was like, wow, people don't get the concept that the U.S. has to be competitive in this market and choose to challenge anyone trying to make another dollar or another central currency. You'd have to be crazy not to, because it will disrupt all that debt that's out there in those treasuries. So when I hear, Russia, China, India, and others are trying to do a new fiat currency-based currency, I talked about this in an episode, like I want to say late 2020. Yeah, I'm pretty sure it was late 2020. It was called the Global Reserve Currency Game Theory. I really have to find a way to like post some of these episodes in like, I guess, whether it's a Discord or a chat that Jessica has. It talks about that very concept and what has happened. And I'm sorry, let me wax poetic about this because I think it's really important. What has happened specifically here is that other nations, not currencies, have started to realize that the U.S. wants us to do this thing where if markets are shaky, buy our treasuries. And what they're asking you to really buy is buy the money markets and roll your cash through us And then as we give better interest rates on longer dated paper, you're going to choose to buy them. What the pushback has been is that, well, you want to cut your rates to such a rock bottom price. There is no value for me to buy your treasuries. I'm going to find another means, or I'm going to make another arbitrage, or group with someone else to kind of corner certain important commodities or other things that can allow me not to have to just buy your treasuries or your money markets. So, or T-bills are what they'd be called, but they're money markets. So that's the game that the other nations are playing. And as long as the US is like trying to fight and not allow that to happen, it becomes hard. Now you would say to yourself, well, it's not as just simple as fighting. What did the US do to correct that? It's not as simple as just saying they decided to raise interest rates. What they decided to do was give those sovereign nations and these other people some sort of incentive to continue to buy their money markets. And that's where you started hearing the word reverse repo, or quantitative tightening. It was just a means to make sure that those nations didn't have to continue to buy all of these treasuries or buy into the US dollar, as the US dollar was underperforming or was giving you no yield. They were giving them a form of a rebate on the back end to allow them access to get higher returns if they chose to buy those money markets or certain 2-year, 5-year treasuries. And a lot of these nations took it. Then the next step that they took was to be more aggressive with raising taxes. Most people probably don't even remember this because, this administration is not held to their whole, we're going to raise taxes on the rich, though they said it. They had to start pushing that initiative because sovereign nations, again, like China, Brazil, all these kind of people, were pushing back and saying, well, we're not going to fund you out of your recession, because you could get a nation to fund you out of your recession. Just continue to sell your treasuries, long dated, whatever, however you want to sell them, as long as you just get them to bid on them. You're getting money in exchange for promissory notes, right? So you fund yourself out of it. So that's why you started hearing that talk more aggressively, like we're going to tax unrealized capital gains, this, that, and the third, because they needed to make that dog and pony show and try to implement it. But the true reality is this administration has not even done that. And if you want to know the proof positive, that I'm telling the truth, pay attention to have any tax rules changed since the Trump administration. None have changed. When Donald Trump came into office, he immediately repealed the Obama tax rules, like immediately. Like the first year he was in, he repealed them. They took place and they took effect the second year. This administration is going on year 3. They've done nothing. So that answers that question.
So E, I have a question for you.
Sure.
Do you see that we're going into a recession? Is the data indicating that, as some of the speculators are hinting, but they're not saying?
So we're not in a recession, but we are headed towards a recession. If you want to know really how, because it's like some people say, oh, copper production is down, this or that is down. You don't need to look at any of those things. Everything starts from treasuries. Even if a person is mining copper, they have to take loans to do it. When the 10-year and the 2-year begin to invert, you are in a looming recession. It doesn't mean it 100% happens, but it has happened 80% of the time. And that recession generally takes place in about 19 to 24 months. Our 10 and 2-year has been inverted for a number of months. We are likely headed for a recession. There's another inversion that is taking place. Again, all of these are in the podcast and they explain them at length. They're the most recent episodes. There's another inversion that's taking place between the 30-year and the 20-year, making the 20-year more attractive than the 30-year. And the whole reason we're raising interest rates is to make the 30-year more attractive. And what is happening is that people are refusing to bid on 30-year auctions. I know that this may sound like jumbled or like, okay, this is treasuries and all this stuff. I just want to know like something where something's underperforming. The performance of treasuries extremely matters, is because that's where the borrowing is done. You create what you're going to issue for debt based off of those numbers. And if you have a dislocation, and when I say dislocation, meaning where it's hard for you to finance at, let's say, 5% in 10 years, but instead you would have to finance at 7 to 10% in 5 years. That shouldn't happen. And that's an inversion. And that's what's happening. And it's happening because people are refusing to take, less interest for longer. When really what you want them to do is take more interest for longer, but they're not willing to take that amount of time. They don't want to hold for that amount of time. They're unsure, they're uncomfortable. So if you can read that and understand it, though it's a little more fine in its understanding, it actually unequivocally tells it to you, because that's where your lenders are going to lend from. They're going to use those bases to lend. And you can simply figure it out because corporations the ones that couldn't refinance, that's what they're having to do right now, is pay a lot more for a shorter end than a longer end, hence an inversion. It should always be, I pay more for a longer end, less for a shorter end.
Thank you.
You're welcome.
Hey, Al.
Yes.
Can you break down Japan's economy in like a macro view?
I don't have any plays going on in Japan at the moment, so I'm not able to necessarily do that. But I can take that question down because we're getting into the 30-minute mark, and I don't want to avoid it. Can I get your name so that I can do it for you? Hold. It says Carl. Is that right?
Yes, sir, Carl. Appreciate you. Wow.
No, just give me a second. I want to write this down on my iPad. Carl, break down Japan's economy, and give me the last part.
From a macro view, just versus other economies, so to speak.
Yeah, got it. Japan's economy from macro view. Got you. I don't know if Jessica will do this next week, but if she does, I will make sure to come on to do that for you, Carl.
Indeed. Thank you, Al.
You're welcome, sir. I'll take like two more, and then sorry. I thought, again, my apologies. I don't really know how to toggle this thing the best, but I'll take two more real quick.
I got a question though.
Yeah.
It's about gold. I'm wondering why it's pushing down so aggressively when it should be going up, seeing that it's supposed to be where you put your money when like safe haven.
How old are you?
30.
All right. So when the last recession was happening, you were like still in school. Like I'm 38, so you would have been like what, in high school, maybe?
Yeah.
Okay, that's probably why you're unaware of it.
Graduated in 09.
Demand destruction. People often think that, okay, well, this uncertainty, we're going to get into this commodity super cycle. Whereas when you have these aggressive moves in rates and you have demand destruction, actually gold can go down. It does go down. You would tend to see gold go up on the early part of that cycle of demand and uncertainty. But once you get into the end cycle of demand destruction and you have central governments actually taking action to be aggressive with rates, you tend to see that gold slows down. It's the same thing that'll end up happening to oil, but it's just not happening right now, this very instant, because people are choosing to consume it.
Okay, appreciate it.
You're welcome, sir. Really quick, I just want to answer. Yeah, I have a podcast, George. It's called Trade Talk with a Hedge Fund Insider. I'll just type it into the chat. It's on Apple and Spotify and all the other places you can get a podcast.
Okay, thank you very much.
You're welcome. And then I'll take one more, and then I gotta wrap it up. Please let me know. Okay, so I'll just take this one that they said, you said there's a lot of money to be made in the stock market within the next few months. Could you explain in depth? So the depth of it is just that you're going to have big consumer brand bankruptcies. The reason you can know this is because when you have inflation in food prices, and this is even, prepackaged foods and like cereals and stuff, what do people choose to do? They generally choose to buy store brand. as opposed to paying, $5.50 for a box of Frosted Flakes. I'm not saying they cost $5.50, but I know they're more expensive at this point. So people buy more store brands. You can't think about it from the aspect of what you wouldn't eat. You have to think about it from the aspect of what the average person can afford. And when you start to think about it that way a little more, you start to realize, oh my gosh, we're going to have consumer brand issues. If you want to know the most recent consumer brand issue, there's a legacy brand of 90 years, Revlon Cosmetics, just filed for bankruptcy. There will be more of those that'll file for bankruptcy that are all equities in the stock market. You have issues at Wayfair, issue at Casper mattresses, issues at Blue Apron meal prep services, issue at Build-A-Bear. You will start to see these issues because the second part that leads into that is just like I was speaking about with treasuries. It's costing them more to finance. They can't get to the 10-year part of the curve to buy to base their lending off of 10-year treasuries. They have to buy within the 5 to 7 years, where we have an inversion, meaning you're paying more to finance in 5 to 7 years than you are in 10 years, and they can't get to 10 years. So that's another reason why. And it's exponentially more expensive, meaning you are paying anywhere from 7 to 10% to finance in that 5 to 7 year window, as opposed to that 10-year window where you can easily pay 6 to 7 years. Now, you would say to yourself, well, why is that 10-year window cheaper? It's being cheaper because the Fed is now, raising interest rates, correcting the longer end of the curve. It's correcting, but that doesn't mean people have demand to offer you credit at that length. You follow? So hopefully you follow that. But the next part of where there's money to be made in the equities market, obviously, as I said, with oil, like I said, right now, most people would never say like, oh, that makes sense to buy, like, oh, oil's going down short. As I explained to you, you can't get a spot price on diesel fuel right now. Diesel fuel national average is 6%. I mean, not 6%, $6. You'll see if I speak to you guys, let's say in November, you'll probably be like, damn, he was right. It's not about like, just I told you so. It has to play that way very specifically because we are absorbing the demand right now. Though people are complaining, they're paying. When people can't afford it, they really do stop paying. They just don't pay. They choose to another route or another way to do something. If you want to know how true that is, in certain cities right now, they will pay you to not drive to work. So you don't consume gasoline to have to force the demand destruction. But there's not many places that are doing that. So that's another example. I could obviously go on and on, but those are some of the reasons why there will be a lot of money to be made in the equities market going forward. And then lastly, like I was telling you before, you will have a weak holiday season. It's not that hard to understand because there's not going to be anything direct stimulus related. And people's discretionary, and discretionary means money that you can use as you see fit. It can only stretch for so long because there's the increased cost of food and energy, and it's aggressive increased costs. So I repeat it, don't be fooled by, okay, well, they finally found some demand destruction for oil. No, you can tell by what the holiday season shows. Look around you. How many of those people are choosing to travel? Well, they're feeding into the inflated price of energy. They're not staying home, and they have no intent to. So I thank you guys. Go ahead. Yeah.
When you said there's money to be made in the equities market, you mean futures?
You can make money in the futures too. You could, like I told you, so on the futures aspect, you can trade the hard commodity of oil. Obviously, you can't trade all the metals anymore because that those have changed dramatically. But the real money, if you're saying that you want to make money in the futures market, is in the soft commodities, in the consumable meats as well as in the grains. We have planted far less corn, planted far less wheat. All of those things have significantly been planted less due to war in Ukraine and due to sanctions. So there's still demand for those things. Any people who were Muslim, during Ramadan time, where they were having so many issues with being able to get the necessary things that they needed to make the foods that they wanted, that has not stopped. And you're definitely not planting in war zones where the majority of that wheat, the majority of that corn is coming from that area. So yeah, there's money to be made in the futures. I know that it may not have pairs on some of those FX brokers, but I can only just tell you, like, if you choose to understand it or whatever, I don't want to say whatever because it's not nonchalant, but if you chose to understand it, that like you're going to see later, like there's a lot of money to be made there because that's where it's going to be. And if you can't understand that to get into it, you don't have to. You can trade oil. Most people, I'm not telling people like, oh, just go do it, whatever. I'm just explaining to you, if you really think about it and you do your research, one of the key things you will find out is that you cannot get a spot price on diesel fuel. They've already projected it to be higher. Just because it's in this part of the cycle means nothing. Go look historically from 2009 to 2010. You'll see oil fell down and then popped like hell, reaching all-time highs and just running. And you'll probably see that again. So I thank you guys. And check out the podcast. Yeah, I don't really have anything else to say.
Thanks, Al.
You're welcome. All right, guys, take care.
Thanks, Al.
You're welcome. Take care, guys.